Good afternoon and welcome to CanadianAgMarkets.com. My name is Brian Como and today is the 4th of June, 2025. All right, let's roll through the ag markets today. We're going to get a little bit nerdy on some currencies and some bond yields and things like that. But first, let's get into what happened in the markets today. So we're looking at $3.70 loss on July canola today. $6.95 is where that's settled at. Minneapolis wheat was up a nickel and a half at $6.23 and a half. Kansas wheat was up 3 3/4 at $5.40 and a half. Chicago wheat was up 7 1/4 to $5.43 and a quarter. Soybeans were up 4 1/4 at $10.45. Corn up 1/4 cent at 4.38 3/4. The Canadian dollar traded higher today, 73.19. We're going to dig into that a little bit. Live cattle up 242 to 212.35. Feeder cattle up 265 to 303.88. All right, we're going to focus a little bit more today on the currency and economic side. So today, the Bank of Canada held its key interest rate steady at 2 3/4%. I would consider this a bit of a dovish statement that they issued. I'm going to read here an excerpt from the statement or a couple of pieces of the statement just to kind of give you the flavor of what they're talking about. So this is verbatim here. Since the April monetary policy report, the US administration has continued to increase and decrease various tariffs. China and the United States have stepped back from extremely high tariffs, and bilateral trade negotiations have begun with a number of countries. However, the outcome of these negotiations are highly uncertain. Tariff rates are well above their levels at the beginning of 2025, and new trade actions are still being threatened. Uncertainty remains high. I think that's one of the key points there is uncertainty remains high. With uncertainty about U.S. tariffs still high, the Canadian economy softer but not sharply weaker, and some unexpected firmness in recent inflation data, Governing Council decided to hold the policy rate as we gain more information on U.S. trade policy and its impacts. We will continue to assess the timing and strength of both the downward pressures on inflation from a weaker economy and the upward pressures on inflation from higher costs. So there's a bit of a dichotomy happening here between economy and inflation. But overall, I still think this is a more bearish report. What's interesting is a friend of mine actually, right shortly after the statement and the announcement was released, a friend of mine who is a currency trader released this on LinkedIn, saying that that he expected the trading floors of the FX trading floors today to be asleep at the wheel, as he felt that the announcement was relatively boring. But that is not what happened today in currency markets. I think there's some interesting things here. Not all of it's related specifically to the interest rate announcement in Canada, more so from other areas. But I did want to kind of go back to this chart here. This is the Canadian dollar. Let's take a look at this here. We made a new high today in the Canadian dollar. Settling, or at the time of this recording, it was trading right around 73.19. That is a new high, new recent high. So, and which is significant, I think, because if we pull back on this chart a little bit, you can see that there's a whole lot of air up here now until we kind of reach this 74.50 area. So there is a lot of opportunity technically for the Canadian dollar to continue to rally, even just from a technical or charting perspective. Lots of air up there, as they say. So why would that happen during a dovish, or which is a currency term for bearish, statement from the FOMC, or not the FOMC, the Bank of Canada? Well, it's mostly what I call type 2 strength, meaning we're seeing weakness in other areas or other currency crosses, namely, of course, the US dollar. This is the US dollar index as of late. It has been, drifting lower since the middle of May, and, was down today, down below 99 points on the US dollar index. One of the reasons for that is that treasury yields are heading lower. Some of the largest declines that we've seen in treasury yields since the middle of April. This is a headline pulled from the Wall Street Journal here, which is interesting. When we look at today, Specifically, you could see that there was a big decline in bond yields just today, but even since the 19th of May, when we traded bond yields above 4.6%, they've now fallen to 4.3, 4.36, even a little bit lower than that during the trading session today. So it kind of begs the question, why are US yields declining? So imagine that the bond market is a barometer for economic weather, right? When the skies look stormy, investors seek shelter in safer assets like US Treasury bonds, which sends the bond yields down. So, why is this happening? Well, there are some economic clouds that are gathering. Recent reports have shown that there are signs of economic slowdown. Job growth in the US is slowing. The private sector only added 37,000 jobs last month, which was far below expectations. The service sector is contracting as well. The services industry, which is a major part of the economy, showed unexpected weakness in the last month as well. These, kind of indicators suggest that the economy might be cooling and prompting investors to move their money into safer investments like treasury bonds, for example. So there's increased demand for these bonds, which drives the bond prices up. We'll show that in a moment, and yield prices down. So it's an inversely correlated thing. So there's also continued, tariff uncertainty, tariff turbulence, uncertainty around U.S. trade policies, especially tariffs, have made businesses cautious, and this uncertainty affects their planning and investment decisions. Leaning to or leading to economic uncertainty, economic jitters, things like that. So, as far as interest rate expectations go, with signs of economic slowdown, there is speculation that the US Federal Reserve might cut interest rates to stimulate growth. Anticipation of rate cuts makes existing bonds with higher yields more attractive, which increases their demand and pushes the yields down. Okay. So, just to kind of show you the inverse of this is the 10-year note. So, this is the value of the bond, not the yield, but the value itself. So again, it's inversely correlated to yield. So as you see, bonds are rising. They moved up to 111 today on the 10-year note. um, you know, there are some global investment shifts happening. Forward investors are reassessing their US bond holdings due to currency fluctuations, better returns elsewhere, which can shift demand for US treasuries, again, influencing yields. So overall, economic uncertainty in the US and globally is still causing some concern and is causing, bonds to rally and yields to move lower, which is negatively affecting the US dollar and positively affecting the Canadian dollar. All right, enough of that talk. Let's get into some of the commodity charts. It wasn't really a standout day in a lot of these commodity markets, so I'll just highlight a couple of charts here from the ag commodity sector. Here's November canola. This is a classic example of what I would call a boring sideways day. When you have kind of a candle like this with the tail and the wick kind of this, the same size, and the market closing relatively close to where it opened on the day. They call that a Doji candle, and it kind of signals that there is uncertainty in the market and that traders aren't really willing to push the market in one direction or another. So it's a very kind of neutral or boring style of chart candle pattern at this point. So can't really say anything too much about that. As you can see, on the November, this channel might be getting to look important here. We kind of saw a test on Monday of this 23.6% Fibonacci retracement. Not that that's necessarily an important retracement level. The 38.2 would be a much stronger one, which lines up currently with the 50-day moving average or close to the 50-day moving average. But if it's going to be sideways for a while, we might actually trade inside of this channel from 670, up to the 695 area. It could, ratchet in between those areas, which is good in some ways. If we can see the market rally up to close to those highs and you miss the boat on getting some coverage on or hedging or even some risk management tools on the new crop when that happened, it might give you another opportunity, even if it isn't going to break to a new high. So if it does do that, I would highly look at taking a look at some of those risk management products that are available in the marketplace. Let's take a look now at July soybeans. Again, it's kind of a bit of a mixed bag today. We saw some declines last week. This week, we're up on the day. We did see a test of the 20-day moving average. We got a cluster here of moving averages, which again signals some neutrality in the market. We kind of have a channel, rising channel here, and we've kind of tested. Although the last couple of days are the bottom of that channel, so I don't know how reliable that channel is at this point in time. But we did see kind of a test and a rejection of the of this low that happened at the beginning of May, about 10:35 ish or so. We did trigger some stops that maybe have pushed it a little bit lower than that area, but we've traded back above that level now. So are we going to see this kind of channel continue higher? Or are we going to see, some more neutrality? I think the weather will be an important factor in determining that in the next, 4 to 6 weeks. Minneapolis wheat regained a lot of the losses that it sustained yesterday. So, over the last couple of days, we've been relatively neutral. As you can see, that punched a new high. We haven't gone back up and tested that yet. We also haven't broken above that 200-day moving average. I think that will be important. That looks like it's acting as pretty strong resistance at this point in time. Again, probably a weather market here as well. We probably need to see further weather fuel to continue to light this fire. Looking at weather a little bit more closely, this is 7 days of precipitation as of June 3rd across the Canadian prairies. As you can see, huge swaths of Saskatchewan still very deficient in the last week. Big parts of the northwestern part of the Manitoba agriculture area are still dry, and into the central east part of Alberta as well. We did get some good rains here in the south east part of Manitoba, and actually a lot of southern Alberta looks good, which is rare at this time of year or at any time of year. So maybe there is a bright spot in southern Alberta at this point in time as far as precipitation goes, but there's lots of risk out there for the rest of the provinces and areas. All right, looking at this is a 5-day forecast, 120-hour forecast. Again, it looks, continues to look dry in this area. 25 millimeters is an inch. So, we don't see a lot of areas other than in some areas where we've already received some rain, southern, central Manitoba. In some ways that's a good thing for some of the fires that are burning in this area of Manitoba, but vast swaths of Saskatchewan still remain dry and largely at risk. So our thoughts are with those people. Our thoughts are also with those who are getting evacuated and are having their property destroyed as a result of a lot of the fires that are happening because of the dryness this year. So yeah, hopefully all of that gets resolved. Rainfall would do great things for a lot of people across the prairies at this point in time. One bright spot for the Canadian prairies, though, is tonight is game 1 of the Stanley Cup final, where the Oilers, which I think is our Canadian adopted team now, take on the Florida Panthers for the second year in a row. So go Oilers, go. Thank you for joining us. We hope that you had a great day today, and we'll see you again tomorrow.